In this video, I'm going to talk a little bit about what I'm going to call phase four of the stock market cycle and the business cycle. So to refresh your memory a little bit, if you've been watching the prior videos, phase four is going to be this region up here when we're looking at that peak in GDP. All right. So if we're looking kind of generally in that period, we're kind of right on that edge between the expansion and the contractions. We're right there at the peak. So let's kind of take a look at what this is going to be characterized by. So as a sort of a brief description here, we're at the peak of the economy. Bond market started going down a while ago. Stock market started going down a little while ago, and inflation is typically ongoing. So what this is going to mean then is essentially the Federal Reserve has been chasing after that inflation. So interest rates are typically going to be a bit higher, but that inflation is still elevated. And if we kind of back up through the cycle a little bit, so in phase two, the consumer started buying a whole lot more things and engaging more economic activity, which meant in phase three, that was ongoing, but also we now had businesses started doing things like expansions and building more facilities and things like that, more transportation and shipping. And so if all of that extra construction and building is going on all the while the consumer is buying more stuff, then basically what's going to happen more in phase four is, well, now it's all about all those raw materials and things, because now I got to essentially replenish or replace all of that, all those building materials that were used. Maybe it was machinery or produced building goods. Well, now I gotta get more like the raw materials kinds of things to start making some of those produced building goods that were used in phase three. So now we're gonna have more of some of the basic materials and things of that nature. But also another way of looking at this is inflation is ongoing, so too much money chasing too few goods. And so one of the things that people tend to head towards from an investment standpoint when inflation is ongoing is they tend to be focusing on like physical goods, like raw materials and things like that. So really kind of with both of those, whether it's heading that way from an investment standpoint or due to just the demand, the money chasing the goods, because now we have to replenish all those things that were used up in phase three. Basically, what you're going to typically see here is a lot of those more energy, basic materials, things like that. So whether that's aluminum, other non-ferrous metals, chemicals, forest and paper products, mining, steel, precious metals, a lot of those kinds of things tend to get driven up in this kind of phase. Energy tends to be a focus as well because we're using energy to turn all of these raw materials into other goods. Also, we have inflation and things like that going on. So oil drilling, oil field equipment, pipelines, natural gas, possibly even coal. So those kind of companies tend to thrive a little bit more here, basically because there's more demand for the energy. And so companies that are producing those products tends to be better. And also, again, people are looking for places to put their money in things that hold value, and they're thinking that raw materials might be that place. So what's really kind of driving this is inflation is driving the commodity prices higher. So it's the money chasing the goods. So people are chasing all of these kinds of goods, basically because of what's been going on in the economy, and also because people are concerned about the dollar losing value. For instance, they may also be looking for places to put it that are physical, tangible goods and things like that. So in terms of the yield curve, generally what's going to be happening here is because the Federal Reserve has been raising rates to combat inflation, very commonly the yield curve is going to be pretty flat or possibly even inverted by the time you get to around phase four. So when you see an inverted yield curve, it communicates the Federal Reserve has been essentially actively trying to pull money out of the economy and slow the economy. And so that kind of tells you what they've been trying to do there when the curve has gotten inverted like that. And so typically that would mean that that's not a great scenario if you're a bank or financial institution and you're having to pay your depositors higher rates. You aren't necessarily making tremendously more on your long-term loan portfolio, and that's going to squeeze your profits, right? So that's going to be kind of a challenge. Now, in terms of general economic conditions, the economy basically just hitting that peak, right? So the economy had been growing, but now it's hitting a peak here. It's about to slide into a recession there. Unemployment was low. Right? People had jobs because the economy had been growing for so long. So unemployment is typically low, and it generally won't start deteriorating until a little bit after the peak, typically. And in terms of inflation, inflation is high. Federal Reserve is chasing after inflation, so short-term interest rates are high. The bond market is going down already. The stock market is going down already. And we're kind of right on the cusp of tipping into a recession. Okay. All right. So that's kind of where we are for phase four. Okay. So that kind of explains how things work out for phase four. Hopefully that makes sense. Thank you so much for watching and have a great day.